on this computer. Okay. Awesome. Well, welcome everybody. We took a hiatus for a few months, but we're super excited to welcome everybody back to our We Fund LA Community Roundtable. And a special welcome to all of those who are joining for the first time. I think the Community Roundtable was born from a desire to educate and to collaborate. And if you recall, we started these calls at the onset of COVID, and they quickly evolved into something special. I think our roundtable has served as a platform for everybody to share industry updates, for people to share best practices. Most importantly, I think our roundtable has helped all of us stay connected with one another. Personally, what I miss the most is just seeing everybody at an office meeting, catching you at a caravan, or the fun twilight events that some of you have put on in the past. Looks like we're headed in the right direction, and hopefully we'll get to that or get back to that here relatively soon. We're super grateful, right? These calls would not be possible without the insight and expertise from all of our amazing speakers. We've had guests from all walks of life. We've had, real estate wizards, valuation experts, medical professionals, and we even had psychotherapist Dr. Tina Payne Bryson talk about parenting during the pandemic. And our future lineup is also amazing. So we're really hopeful that you can join us on our subsequent calls. Before I introduce today's speaker, a couple of housekeeping items. Again, if you're at a place where you can turn your camera on, please do so. It'd be awesome to see you, even if it's just virtually. Please keep your lines muted during the presentation so we can avoid any background noise. We will have a Q&A session at the end of the call, and Evan Farley will be monitoring our chat box as well. So if you want to type in any questions in the chat box, please do so. And again, we highly encourage your participation. This is a conversation. This is something where we hope you can be as engaged as possible. And if you have a question, somebody else on the call likely has the same question. So don't be afraid to ask. Linda is an open book. She is awesome. Our guest speaker today is Linda Whittlesey from Alliance Appraisals. She's our resident appraiser. She is an incredible wealth of knowledge. She's been a friend, a resource to the We Fund LA team and to Finance of America for many years. She's one of the most respected appraisers in the industry. She's not only a resident of the San Gabriel Valley, she's also a real estate investor. And so with that, we want to welcome Linda to our call.
Thank you, Daniel. So delighted and excited to be with the A team here again. You guys, every time I go out to an assignment that you're taking care of, it's universal. Everybody seems to know who you are, who your team is, and all I ever hear is, "Oh yeah, they're great. Oh, that Daniel, he's great." So your reputation precedes you, and it's well deserved.
Thank you. The check's in the mail. So we've had, I'm sorry, go ahead.
Well, I would hope so. Gosh, this market is insane, isn't it? I mean, holy cow. What we see all over the San Gabriel Valley is stunning. Specifically, Altadena, just as an out of the blue, Altadena has just gone insane. Agents, I think you would probably nod your head if you can agree with what I'm saying, but even just as little as 3 or 4 months ago, we didn't see this in Altadena. All of a sudden, about maybe November, suddenly everything was being bid up there. And I think what we're going through now could be a textbook example in an econ class in terms of the effect of interest rates on a market combined with the effect of low inventory. I mean, this would probably be up on a whiteboard in an A-level econ class, but we're living through it and seeing it. And, luckily the underwriters are beginning to see it too. I can think of times a few months ago that I would get a call. Now, to their credit, not from the underwriters at We Fund LA, but from underwriters from other lenders saying, "This value scares me. Are you sure about this?" And you really could back it up because we had insane pending listings that would, go right along with the value of the property, and a small adjustment on the comparables that had closed a couple months back, and it did make sense. And those loans went through, but it takes a little more explaining these days. Same thing with El Sereno. And Daniel, I think you were the first one that pointed out maybe 4 years back, what the heck's going on in El Sereno? I mean, it's out of control. It's, I would suppose, yet another last bastion of affordability, and now it's perhaps not. What I see that is not insane right now, I think might be obvious to a degree. Commercial is still deeply impacted. What's going to happen there remains to be seen. But commercial would be 3 items. Commercial would be the first one. Secondarily, small investment units for residential. Instead of shooting up in the past year, just as a round number, maybe about a 5% negative impact. And I think that comes primarily from fear, having had perhaps necessary government intervention in the last year. The smaller investors are just a little afraid to jump back in. They're concerned that if they're going to be carrying a mortgage, are they going to be getting paid? What might happen next? So we do see a little bit of a pullback there. Units aren't going out the door, generally speaking, as fast and as high as they were 15 months ago. And then also in San Gabriel Valley, I'm noticing, well, for one, my immediate area, Arcadia, there's an awful lot of active listings in Arcadia compared to any of the other surrounding areas, especially in the larger homes, and then perhaps universally in the San Gabriel Valley. Anything above 2 million, I don't see going anywhere near as quickly or as crazy or above market in general as anything closer to the 1 to 1.4 range. You agents are really the experts in that area, but from my little corner of the market, that's what I'm seeing. I think I have at least one appraisal coming up where the higher end property in Pasadena in about the 2.5 million range is selling for exactly what it did 3 years ago under no sort of duress. It's just no takers, it's a beautiful home. So I think that's interesting to me. I think that's telling, and I don't think it's too unusual.
Yeah. Hey, Linda, so as COVID was evolving, a year ago, there were a lot of questions what impact the pandemic would have on our industry, what it would do to home prices, what it would do to interest rates and loan programs. And you fast forward, a year later, and home prices have skyrocketed, appreciating in probably double-digit territory, if I'm not mistaken. Does this spike in home prices, cause you to approach your value determinations any differently? I mean, how are you approaching these? Are you looking at actual listings that are not under contract yet or have not officially closed? Are you giving more weight to those because you see value trends going up? I mean, how are you approaching a value determination in today's market?
Sure. Well, let's go to your point about active and pending listings first. Typically, previous to this increasing market, you're going to include 2 active or pending listings with your report because the lenders require it. They're not going to be weighted so much because we can't rely on them. They haven't closed yet, but they're ancillary support. They're just, they're proving your point a little bit farther, the point that you've made with your closed sales. But currently, they're getting more, I guess I would say they're more important than they used to be, because they show us the direction that the market is going. And we can't rely on them unless we have the support of the closed sales. And we can't adjust upward on the closed sales unless we have something that is at or above the value that we're determining. So that's kind of a good point I was going to bring up a little bit later, but that's something that's really helpful when we go to talk about what information you can provide to the appraiser to help support a contract price. We have to have at least one comp that is at or above the value that we determine. We can't adjust up to that regardless of how quickly the market's going up. There has to be something. If your purchase price is $1 million, there has to be at least one comp that is at $1 million in order for that to be the determined value. That's just an underwriting rule. It might not make sense to the real world, but it makes a whole lot of sense to Fannie and Freddie, and you're not going to get anything through without that. And so if you have a listing that's under contract way at the top of the range, and you'd like to provide some helpful information, make sure that one piece of that information supports that price at, not just adjusted upward. It has to be there or above. That's oftentimes these days the hardest comp to find. Something that is ahead of the market a little bit. It might not be next door, but it has to make sense. It has to be a reasonable comp. It can't be from a far superior area. It can't be a much larger home. It can't be something we're just throwing in simply because it's higher. It has to make sense as a comp. So, did that answer your question well enough, Daniel?
Yeah, it did. I think Leslie also has a question.
Fire away.
You're muted, Les. Let's see here. Oh, there you go. Oh, hold on. Got you now.
Okay. So I wanted to touch on that a little bit in regards to pending listings. Now, would it make a difference if you, do you reach out to the listing agent for a pending listing? And what if they say, hey, this is closing in 3 days. All contingencies have been removed. We're closing this escrow in 3 days. And you're working on the appraisal report now. Does that influence the amount of weight that is given to that specific listing? Because I feel like I've been in a couple of those scenarios where things are closing later that week. Appraisal is being done now. It's a great comp. It's nearby, and it's in the market that we are now, where they're getting multiple offers. So would that affect your opinion of a good comp?
Yes, but again, it can't be weighted. It has to be support. It can only be essentially, proving our point, proving the thesis that we've already relied upon in terms of value. But they certainly do help an awful lot in terms of talking to, when it's a little bit uncomfortable for the underwriter, for whoever's reviewing the file. We love to have that information, because in a normal market, they're going to look at what's pending and want us to discount it a little bit. They're going to say, okay, it was listed at $1 million, and it sold. It was under contract in 24 days, and so we're going to assume it's maybe at $1 million, probably at a percentage point or two below $1 million. But in our current market, if something's listed at $1 million, it's probably going to be under contract in 10 days. And it's probably going to be under contract for $1,150,000. And so there's going to be a couple of sentences of explanation on that. And that helps the underwriters to understand what we're talking about and further supports it. But that information is hard to get as an appraiser. We'll put calls out, and the agents are doing their job. They're not sharing that information, but they will sometimes kindly say, I can tell you it's in a range of A to B, or I can tell you it's most definitely above the list price. And that's supportive, that's helpful. And we add that into the paragraph of discussion about the comparables and the pendings and the actives. And sometimes we're lucky enough that when you work a small market, you have appraised one of your pending listings, and you can share that that you are 100% comfortable that this is pending at. We might not reveal the actual number, but give a percentage, because we can't share the contents of someone else's appraisal, but we can use that as support. And we can also cite what another agent has told us, as long as we have in our work file who that agent is. We didn't just say, we spoke to an agent and they said it's pending at $2 million. Does that answer that, Leslie?
It does. And actually, you made a good point towards the end of that, something that I wanted to ask and touch on. I think you and I had a conversation about this kind of offline about, what was it, maybe a week ago or 2 weeks ago. So we all know the appraisals are paid by the buyers. The appraisal reports are owned by the buyer and are the intended use for the buyer and the lender to determine, lending terms and a decision on providing a loan for that home. with that said, I think it's very common in our industry, especially as we get comfortable with each other. We've got, you know, a specific panel of appraisers with our escrows, and so we all start to know each other and get comfortable. But I think that Linda, you and I had a conversation about, you know, agents asking for, real estate agents asking for value or wanting to, you know, kind of get an idea, okay, how are we looking? And that kind of is, you know, there's compliance behind that, again, owned by the buyer, and for the lender to use to determine lending terms. So I'll let you kind of touch on that in the conversation that we had regarding that.
Right. Yes, exactly. Yeah. And I know that you were concerned that sometimes this is a point of misunderstanding, but for the appraisal, embedded into the language of all of these reports within the template from Fannie and Freddie is the language that the client is the lender. They are our only client for this appraisal. And if we share the results of the appraisal with anyone other than the client, that is a huge ethical violation for an appraiser. That could get us in a whole lot of trouble. And I know it's ever so common to ask, how's it looking? Are we okay? Do you anticipate any problems? What did it come in at? I understand, you know, nobody wants to lose sleep over this, but we really can't do it. We really can't answer that. It's very clearly stated. It's one of the most common reasons that appraisers end up in the state board with their license under review. You don't want to get people in trouble. You know, just give it a couple of days. We're turning things around quickly. Provide all the support that you want. You know, we're always happy to look at anything and everything that you have in terms of support for the appraisal, but we cannot tell you the results, regardless of the fact that the appraisal is for your client, your client, you know, the buyer. One more little point on that: while the buyer is an intended user of the appraisal, they are not the client. I can't send the report to the buyer. I can't talk to the buyer about the report. I can only provide it to the lender. The lender can take it and make a billboard on Colorado Boulevard with the information if they want, but I can't share it with anyone. So please do your level best to remember that, because we don't want to get anybody in trouble. And if you were on the other side of that deal, you would not appreciate it. Okay?
Sage advice from Linda Whittlesey. Thank you. Yes. Linda, I think you have a question, or Linda Mejia has a question.
Yes. Good morning, everyone. One of the questions was two questions in one. How has COVID changed the way you do your physical inspections? And have you experienced pushback from concerned clients while you're doing the appraisals?
Yes, I have, in fact. I've only had, in this whole year, I've only had one deal that took advantage of saying this is going to be an exterior only. It was on a purchase, and that was the way we did it. Others that have come up like that in terms of a purchase. I going to be wearing? What are you going to do? And, you know, explain that I'll have masks, gloves, shoe covers, and we'll get in and out on that inspection much quicker than I normally would, you know, and that usually gives them a comfort level. Oftentimes people will wait outside of the house. That's great. I'm certainly never going to ask someone to wait outside of their house. And, you know, for that matter, I'm not going to ask them to put a mask on. It's a little strange sometimes to me that people don't, but I'm from the Midwest. It's your house. You do what you want to do. I'll take care of myself, and, you know, we'll hope for the best on that. I'm certainly not going to say, can you put a mask on while I'm here? I just think that's offensive, but I'll wear sometimes too, but I'm not gonna be inappropriate in someone's home. Having said that, I've had it come up also, I think only once, that about 2 weeks after the appraisal, I got the call that the seller and his wife both have COVID. Just want to let you know, they're both in healthcare. They've just come down with it. We're following up on everyone that was on a PEAD, and we just want to make sure everything's okay. And so, as many appraisals as I've done in the last year, and boy, there's been a lot in the last year, so far, knock on wood, thank heavens, it's only come up once that I know of. So that's pretty fortunate. It does take a little bit longer to prep, just for obvious reasons. Let's get out all the gear, but we're quicker inside and out of the house to try to mitigate the time we spend in there. And people are pretty smart. I touch nothing inside a house now, even though I'm wearing gloves, just to be safe. Some of my pictures are a little dim, but we lighten them up and make it work.
Awesome. Thanks for that.
Yeah, but there's a little bit of a risk involved. That reminds me of one more good point to bring up. I know some people have been a little bit blown away that appraisals in the last handful of months have become a little bit more expensive. And I think there's a few things involved there. One is basic supply and demand. There are so many appraisals being ordered right now and only so many appraisers. So, we're going to take the ones that are the best deal for us in terms of the time spent. Two, this might surprise you, but it takes longer to write up a decent report right now because of the values going the way they are. If you really want to try to do your best job in researching and supporting a sales price currently, you're going to drill down, you're going to read a lot, you're going to have to go through the MLS and maybe try to pare down the comps where the agent has wrapped non-living areas into the living area. So you have to go through and, snap into what the assessor says is there. And no, it's not, you shouldn't have included the basement. And it takes a lot more time to write up something that is not going to make the underwriter queasy, is not going to get kicked back, is not going to require a second appraisal or an ROV. So each report is, I'm going to just guesstimate I'm spending an extra hour writing up most of the purchases right now because it takes a lot more support to get it done properly and explain the case and explain why you believe that this is reasonable. It's just there's more support involved. So that's a good hour on reports typically is about what it takes to do it well right now.
Yep. Awesome.
That and the fact that we're walking COVID houses sometimes.
We have a question from Evan Farley on our team.
Yes.
Hi, Linda. I know you've mentioned a couple of times Fannie Mae and Freddie Mac, so I was wondering if you could maybe touch on, how maybe a conventional conforming appraisal, how that market's been affected versus if there's any differences in how maybe jumbo investors are looking at it, or once you get into that price point of 1.5 and 2 million and up, do you see kind of the similar changes or anything, or are there any differences there to what you have to look for, maybe in those higher price points compared to the lower conforming loan amounts?
Sure. Yeah. More than anything, just what I just mentioned about spending about on average an extra hour writing up a better, more thorough report, because at that price point, they really want to have a comfort level that this isn't just the greater fool theory. And people have in the underwriting departments have a pretty good memory on what happened a dozen years ago, and they want to make sure they're not in that position again. And so they want they might want an additional comp. They certainly want all of our sales to have a lack of across the board adjustments. If you follow me, if something has an unusual feature, we're really going to have to drill down, especially in the large loan area, the non-conforming, and make sure they understand how that impacts the market. So it just takes more due diligence, more thoroughness, and quite frankly, more narrative explanation as to why we're valuing things the way we are. And so that's the biggest difference there.
Awesome.
It's kind of logical. If it was my money, I'd feel the same way. You'd want to understand it.
Yeah. I think if you can give maybe some advice to all of our agents here, when they're determining value, when they're at a listing appointment, talking to their client, what's some of the advice you would give to our agent community here about how they determine value? I know they've got probably one of the most difficult jobs out there right now, other than our healthcare workers and first responders. But I mean, when you're at a listing appointment and you've got a seller that's married to this price in their head because they're seeing their neighbors sell at top dollar, what would you advise to our agent community to approach that with, a reasonable and fair conversation about value? I mean, I know they've got a really tough job, but what can they do to better prepare for you to come out and say whether that value is warranted or not?
Gosh, that's sitting on the opposite side of the table now. That's a little bit harder. Yeah, I agree. You do have a tough job because sometimes sellers are just absolutely unreasonable. And I've heard, I know the true hidden value of this house. I'm like, well, please share it with me because I'm not seeing it. But yeah, gosh, Danielle, that's a little bit tough for me to look at. I think more than anything else, the data, the sales. I mean, when you do your CMA, I think you can probably demonstrate things to them, but nobody ever really sees their own house with an unjaded eye. I mean, we all, God forbid I should appraise my own house, it's very hard, I'm sure, for the sellers. But I suppose when you all are out there and you can show them how much better the sales that are listed below market and get into competitive bidding wars are doing compared to something that is listed in this pie in the sky number they have in their head and then sits on the market for a little bit and the bloom is off the rose. I guess that's probably, I mean, gosh, you guys are clearly doing a very, very good job because everything that's out there, you're selling so effectively and quickly and for record prices. So I think you have it going on. But maybe just explain that we have to compare it to what's been sold and it has to make sense and it has to be able to stand up to a careful review. We can't, as much as the pending sales support what we're doing, we can't rely on them. The closed sales have to be there.
Awesome.
All right.
Cool.
I would love to mention things that might be helpful in that same space. Getting close to what you're talking about, Daniel. When you're shooting for supporting a really high contract price, some of the things that might be helpful to the agents. Is that all right? Can I touch on that?
Please.
Great. The first one that I can think of that I think is not very well known is, as an appraiser, I'm delighted to have any and all comps that you are looking at and you'd like to share with me. But if you want that to be the most effective, I would suggest that you share those right after the appointment is made, because the way appraisers work is we will pull all of our comps. We use a form filling software. So we take the MLS number and we use essentially like an app that will take that MLS number and pop it into our report. And then we will print out a map and with all our comps on it and go out to the inspection. So if you give us the comps at the inspection, it's a little bit higher hill to climb because we're going to have to take what you've given us and manually type it into the report. It's a small difference. And if it's a great comp, any competent appraiser should go ahead and do it. But it's going to be a little bit more effective if you can give it to them in advance. We can research it ourselves and say, that's right, that's a great comp. And I'm so glad to know that little bit of information that you told me about it. It's not like I didn't see it in the MLS, but maybe you're going to say, just so you know, that comp that sold low has a non-conforming floor plan. You haven't walked through it, but I have. And this is why it sold for 100,000 less. It has no dining room and a 500 square foot master suite, but there's only a half bath in it. I mean, you know the kind of weird things that you run into, 3 bedrooms upstairs, but only 1 bath. We can't see that from our view. So if you can give us those little pieces of information, or, the backyard is 8 feet deep for a 4,000 square foot house, anything like that you've seen because you've been out to the house is great for us to have. That will help support your listing quite a bit because it helps us explain to the underwriters why we can defeat that comp that's killing your deal, so to speak. And then second, so sending the comps early and along with that inside information that you have, because you've been out there. You're the troops on the ground. You know more than we do about those individual properties. Secondly, anything that's not showing up on the assessor's report about your property, if it's something that has been permitted and you can provide us with that, that's certainly going to help you. For example, sometimes recently there's been a basement that was fully fitted out. It was fully permitted. It had bedrooms and baths, but it wasn't showing up on the assessor's records that way. And if we can get that information, that's going to help a ton. You know, just we at this point in time, only some of the information is online. We can dig and we can try and get it, but we might not see it all because not everything is posted. So even down to like an extra bathroom, you know, we'd love to be able to throw another 25,000 onto your value. But if we don't know that it's permitted, it's probably going to get a little pushback from an underwriter. So that will help us too. Anything that you know that we might not. What else? And I think that's most of what I was going to say about that.
Okay. I think we're going to go to Q&A maybe for a minute or two if we can. And then we did want to give everybody just a couple of, there's been a lot of changes with interest rates, as everybody's, I'm sure, hearing about. And we've actually had agents call us about some fallout. And so we're going to go to Q&A and then give everybody a quick little mortgage interest rate update, and we'll take it from there. Ev, what's in the box?
Let's see. Sid asked, I know this was going back kind of to the start when you mentioned that, you know, ideally, I think the purchase price can't go above the highest comp. Is that mainly for dollar amount that you're looking at, or are you looking mainly at price per square foot? Absolutely
dollar amounts. Yeah, from an underwriting perspective, when we're not looking at a commercial report, when we're looking at a commercial report, price per square foot is you know, secondary only to income. But on a residential report, as odd as it might seem, from an underwriting point of view, they care about that much about the price per square foot. There's too many other factors that can influence price per square foot. So yeah, it's absolutely a matter of the actual dollar amount. You know, if you're under contract at $1 million, we have to have some closed comp that closed at $1 million. Just that. Hope that explains it clearly.
Awesome. Let's see. Peter asked, I know you touched on a little bit on non-permitted square footage, but also maybe specifically if you can talk about ADUs. You know, we've seen a lot more of those going to maybe like an unpermitted ADU, and anything you can expand on with those.
Yeah, sure. Absolutely. Yeah. ADUs are the darling child these days, aren't they? Unpermitted ADUs, it's really going to depend upon the lender to a degree. For example, we don't see much FHA lending right now, but FHA was the first one to come out and say, look, if it has value in the marketplace, we don't care if it's permitted or not. If other people are paying more and they're common in that area, then you would be mistaken not to attribute value to it. But a lot of other lenders don't see it that way. So it's really going to depend upon the lender and what their underwriting criteria is. A dozen years ago, when everything fell out, and nobody wanted to lend on anything that wasn't permitted. And then when FHA and said, no, we think it's fine, we think it's okay, we don't want to leave it out. Did
we lose Linda there?
Can you hear me?
Yep. All right. Got you back. Okay. Have any other questions in the box?
Yeah, we've got a couple more. So Sid, feel free if I miss something, but can other loan officers at same or different banks see the appraisal amount? She had a situation recently where the listing agent was also a lender. So does that value that you submit, does that go to like a place where other people can access that value?
Once we've submitted it to the lender, we don't know what happens to it. I would kick that back to maybe Holly or someone on your side might know, but once we've submitted it, that's as far as our knowledge goes.
Yeah, I think this is kind of good, maybe segue to, and I know this is maybe not necessarily great for Linda, but we are seeing a lot of PIWs, property inspection waivers, especially with COVID evolving. I think Fannie Mae and Freddie Mac came out with more generous guidelines on when a property inspection waiver is issued. And for all of you who don't know what a PIW is, it's basically a automated AVM, an automated appraisal that's done based off of a digital electronic comp check of the property, and it waives the need for a full appraisal. And so I think there is a master database that is probably with Fannie Mae, Freddie Mac, that they pull data from. But I don't believe anybody else really has public access to that data, but they use that data to basically say, 123 Main Street, that purchase price is supported by all of the other appraisals we've done in that immediate area. And we've been seeing a rise in properties being eligible for PIW. So it makes it, it's good for the consumer. They save some money there. And it's also good for the transaction because it's faster. It's one less thing to worry about, one less contingency that we have to write in, one less, bump in the road that we can avoid with a PIW. We're starting to see less of them now too. It's funny, COVID is now turning the corner. I would say we were just talking about this on the team yesterday, that we're seeing less PIWs now. So maybe there's a connection there, but yeah, I think that nobody really has access to that master database of values. So
I think the question was, if we have an appraisal done, let's say by Linda, and we receive it as a lender, does it go into some sort of database? And I think that's what's being asked. Does it go into some sort of database where other lenders, where appraisals are submitted? So appraisals are not recorded. So if we did an appraisal at Finance of America here with us, New American Funding does not have access to that appraisal. So to answer a question, if the listing agent was a lender, also happened to be a listing agent on this one thing, but was an actual lender, they do not have access to the appraisal that we had done and we have in our system or recorded in our system. Remember, appraisal reports are not recorded anywhere. So it kind of dies with a transaction unless the buyer decides to share that information or the lender decides to share that information. Like Linda mentioned previously, they don't have access to it. So it's not recorded anywhere where New American or Movement or Chase or Wells Fargo is going to be able to see our appraisal report.
Man, you just took me back to 2005, where lenders were also agents and they were also the escrow officer, and they also had an action in the title. And
What, is that a problem?
no problem. Nothing to see here. Cool. Ev, anything else in the box before we move on to some mortgage updates?
Yeah. Well, one more real quick, touching on like condos and HOA. So the question was mainly, do amenities such as elevators, cabanas, and pool weigh in as a factor increasing value compared to other units that don't? And I'll just add, maybe like specifically with some of these, the COVID restrictions, if some of those amenities are shut down, is that factoring into anything, or are you all mainly assuming that those will eventually in place go back to being full use?
Yes, two parts to that question. And the first part, yes, the amenities absolutely do matter. But I will say that within a condo complex, there's a general rule of thumb that as an appraiser, that we call it 2 in 1. If you would like to have 2 comparables in your report from the same complex, therefore the amenities are going to be the same. And then after that, you'll have at least one from an outside complex, a competing complex. But if the competing complex has more or less amenities, you would absolutely adjust for that 100%. If there are no recent comparable sales in your subject complex, then yeah, you're going to entirely go to competing complexes. And again, yeah, you absolutely would adjust for that. Secondly, the second part of the question, the fact that the amenities are not particularly useful right at the moment is almost a non-factor. This came up recently also with a house appraisal. The house is across the street from a school, and someone's point was, yeah, the school's been closed for a year. Is that really a factor? There's no traffic right now. Well, Yes, but there probably will be in a month. The school didn't go away, so we have to anticipate what's about to happen as well. And so, yeah, the answer is the amenities are not diminished in terms of value by the temporary situation that we are in. Hope that covers it.
Excellent.
I have a quick question, Linda. You mentioned something that I thought was really important. I think we've got a combination of listing agents on this call and buyer's agents. You mentioned that it is helpful. One of the things that I took note on is that it is helpful if you want to provide as an agent, whether you're a buyer listing agent, comps to help, share information with you that they feel is valuable. And you mentioned, it would be great to have that prior to the inspection. When you call to schedule an appointment with a listing agent, because normally buyer agents also want to share comps. So when you call and schedule with a listing agent, you're not communicating with the buyer agent on the other side that might want to share comps as well. So do you share your email address with the listing agent when you call so that they can then share that with the buyer's agent and then be able to send you comps ahead of time? I think that this kind of is a question that comes up. I'll get, buyer's agents that I work with text me and say, hey, can you send me the contact information to the appraiser so I can send some comps before the inspection? But in reality, I don't have that, right? You are communicating with the listing agent.
Right. Yeah, I'm always happy to, but I don't usually offer it up unless it's asked for. If it comes up in conversation, they say, I have some comps I'd like to share. Would you like me to text them? You want me to email them? Or I'll bring them with me. Then I immediately say, oh, by all means, please email them to me. That would be great. I'd love to see them sooner rather than later, and explain a little bit about why it's great to have them in advance. But that's a great point. I'd be perfectly happy to offer it up in each conversation, but I don't usually offer it up until it's asked for. That's a great point.
Okay, excellent.
Yeah, I'm glad you mentioned that.
Excellent.
Well,
Thanks.
last one, this is probably really quick. Just how useful is providing copies of backup offers or the amount of offers?
Actually, I think it's very useful. I can think of at least one deal that actually I did with Daniel. It turned out to be one of Daniel's loans. Eventually, I found out after the buyer, when I was at the inspection, the buyer mentioned who they were working with. But that buyer's agent came in with at the appointment with the seller's agent. I've never seen this done before. The seller's agent, old school agent for about 30 years, brought a stack that he had sitting on the kitchen counter. And he said, I just wanted to make sure, because there was a lot of question. The deal had been turned down by another lender. Daniel probably remember the one I'm talking about, but there was a lot of question about the value. And the seller's agent said, here are my backup offers. I just wanted you to know that you're welcome to look through them. I thought I was very impressed with that. That was so transparent. I got a big kick out of that. And so, yeah, it is absolutely helpful. And I like to footnote that for the underwriters as well. Whenever that information is shared with me, that according to listing agent Sally Johnson, there were 14 offers made, 5 of which were at or near the contract price, or 5 of which were within $5,000 of the contract price, and it's, one more time, we can't rely on other offers or pending listings to back up the value, but mentally, I think it helps the underwriters a lot to understand, well, I guess the demand is there. I guess that this does make sense, and it does help. It absolutely does help. And it has to be able to be verifiable. So if I haven't seen them, I'm still perfectly happy to rely on them, but I will probably put the agent's number, I'll put a little bit more of the agent's information in there as kind of a CYA, so that, well, who said those offers were there? Well, the listing agent, and here's her information.
I can see all of our agents bringing you a stack of documents of other offers on all the inspections.
Yeah, I've never had that happen before. It was multiple inches thick. It was really neat.
Awesome. Well, Linda, thank you so much for being on today. You've always been a great resource for us. Linda's available for you guys as well. If you have any commercial appraisals, she's an expert on the commercial side. She does estate planning appraisals, prenups, divorce appraisals. She is available for you guys. If you need anything, I know many times you guys have asked, do you have a good appraisal contact? And Linda's the person we always go to and utilize. So Linda, thank you so much for being on today. You can stick around if you want for some quick mortgage updates. If not, I know you are busy and probably have a whole day of inspections lined up, but thank you for being on today.
My pleasure. Thank you.
Awesome. Really quick, guys, if you have a few more minutes, I think it's critical that you stay on for at least another 5 or 10 minutes. Again, we've been flooded with calls and inquiries about what is going on with interest rates. How is that impacting the market? I had a top producing agent call me yesterday saying she had 2 escrow cancellations immediately after acceptance. Offer was accepted. The buyer called their lender to say, hey, my offer just got accepted. Let's move forward and lock in the rate. And rates were higher, and that buyer canceled escrow. So I think it's important for everybody just to get a quick update on what's going on with interest rates, how that's impacting the market. And I want to have Leslie talk to us a little bit about that right now. You are muted, but it doesn't say you're muted, Les.
I'm going to share my screen. Can you guys hear me?
Yes.
Okay, so can you see the screen I am sharing here?
We have your screen.
Yeah. Okay, so this is the 30-year bond chart. It's something we've been sharing with our clients. Recently, we sent out what we call our mortgage minute. It kind of just started, it helps illustrate to clients in reality how quickly rates shifted. We saw one of the most drastic increase in rates that we have seen in the last decade. And so this helps illustrate the movement that we've been seeing. So the higher you are in this chart, the lower the interest rates will be in pricing. The lower you go in the chart, hence where we are now, the higher the interest rate will be in pricing. So, I mean, there's no way to really, paint a picture to our clients other than showing the chart, where the blocks are and what the movements have been. Red is negative movement, meaning rates are increasing, moving down towards the chart. Green is positive movement, right? And so it's been something that we've been taking the time in the last week and a half, 2 weeks to share with our clients. And it's a pretty simple chart that helps see, hey, this is not just our bank. This is not just the other lender you were talking to. This is across the US, across all mortgage rates. And so it's important to understand the drastic shift we saw from here all the way down to here in a matter of about a week and a half, right? That's pretty drastic. Up here, this is the rates we were seeing, probably on average around a 2.75, 2.875 up here. And again, we saw some volatility, all that's normal, but the shock was when we came down, and now we're down here. Now look, there's been a little bit of recovery from that, but we're still not up to the levels that most of our clients were used to pretty steadily from October, easily through December and the beginning of January. All the shifts, you can see the dates down at the bottom. All the shifts started to happen in February, right? So it's very, very recent. That's the shock factor that our clients are going through. Now, the one thing that our mortgage minute stated and that we're taking the time to talk to our clients about is the bond market is almost like this big bad wolf. Interest rates and the bond market thrive off of instability in our economy and in our country. So it's important to put into perspective that, yes, rates in the high twos, mid to high twos were absolutely great, but they were here because of the big bad wolf, the pandemic, right? Something that we want to work through as a country, as a kind of just unified with the world, and we want to get out of. So the rates that we saw was because of the instability the pandemic brought to our country. So it's important to understand our goal is that the pandemic won't be around forever. It won't be affecting us forever, right? We've got stimulus bill conversation happening. We've got vaccines being talked about, right? Johnson & Johnson coming up with a new vaccine. So all of that is important to understand that once we enter some sort of stability, you're going to see rates recover and go back up, right? Rates in the mid to low threes are still historically low rates, right? So it's helpful to put things into perspective that, look, interest rates in the bond market will go down when there's instability in the market. They will go up and recover when we reach stability. So that's the movement that we're seeing now. Now, we didn't expect, no one expected them to move this drastically. We did expect them to increase gradually as we started to navigate through the effects of a pandemic, but not this drastically, right? And so all we can do is share the market with our clients, educate them on what's going on. And in reality, going from a 2.75, if we're talking drastic, to a 3.25, 0.5% increase, a 3.25, 2 to 3 years from now, we're going to be wishing we can get back to the 3.25 we're seeing today. Even a 3.5, 2 to 3 years from now, we're going to be hoping, dang it, I should have really moved on that. So in reality, just quick perspective, we're still in really low rates. They're excellent rates. And in reality, the purchase, you know, buying a home in real estate, there's so much more to it. Real estate appreciation, building equity, you know, and long-term goals, right, for real estate in LA. So that's just kind of the conversation we've been having, just kind of a short little snippet. And it helps that we do share this bond chart with our clients. Whenever they reach out to us, we're making an offer. You know, I tell my clients, reach out to me before you make an offer. We can let you know where the market is. That way they're not caught, you know, too off guard, because you can see the volatility that we've been seeing. So that's just kind of a quick update on where we are. So rates in the low to mid threes are still excellent.
Awesome. Thanks for sharing. Just to piggyback also on what Leslie was saying, I think, you know, the rates in the high twos that we all enjoyed for the last year were also an indication of an ailing economy. Like Leslie said, it was thriving off of instability. There's some stress tests going on, right? There's some stress testing going on. I think that, you know, they're trying to see, can the market bear higher interest rates that are built for a more normal, healthy economy? So we'll wait. We don't know if this is a blip in the radar, and if the test determines that the market's not ready for higher interest rates, and maybe they come back down, right? There's a whole school of thought around that. Or this could be the new norm, and we could start seeing interest rates continue to go up. I think does someone have a payment example on the team of what a payment may look like at 2.75 versus 3.25? I'm not sure if someone had it. It's basically about $400 on $1 million loan amount. So if you're looking at how does this impact a borrower's monthly payment on $1 million loan amount, you're roughly looking at a $400 difference in payment, 2.75 versus 3.5. That's significant. That's going to give someone a moment to pause. That's going to give everyone a maybe take a wait and see approach if all of a sudden they're in escrow and now expected to pay $400 more every single month. So I think also we wanted to talk to you guys really quick about a couple of new products, right, that are going to help us say yes more often. We're all of you know we're purchase focused. We do refis. We do a lot of refis right now just with the rate environment, but we've always been chips all in on purchase. That's where we do our best work. And so we're really excited to talk to you guys really quick about a few new products that will help us put more people into homes, especially for our self-employed borrowers. And Joanne's going to go over that with everybody right now.
Hi, everyone. So we wanted to briefly discuss our new non-QM product rollout. We're super excited to announce this proprietary mortgage solution that's specifically tailored for our unconventional borrowers. So basically, we are now offering programs for those clients who don't fit that traditional, the traditional guidelines due to either credit score, debt to income ratio, or simply they just don't show enough income on their returns. So these programs pretty much range anything from, an asset depletion program where we can basically use assets as collateral instead of their income. It's an excellent option for those that maybe are no longer employed or retired, but just have a lot in assets. Bank statement programs that basically allowed our self-employed borrowers who maybe just don't show enough income on their personal or business returns, basically can qualify them using their bank statement deposits. Clients who maybe have only 1 year of income documentation but have been self-employed for a couple years, we can now work with just that 1 year of returns. Some clients maybe need to be in jumbo territory but fall short of qualifying due to, again, credit, down payment, reserves. We have some jumbo options for them as well. So there's, these programs really are a great option for those clients that just don't fit that traditional, traditional guidelines, and will at least get them into a home with the goal of eventually refinancing into a traditional program. But if any of you have questions or want some more information regarding the programs, of course, you can reach out to any one of us.
Awesome. Thanks for that. Yeah. So really the target borrower is that self-employed borrower who has, really strong deposits, very good cash flow. Maybe they're in a business where they have steady deposits into their business bank statement. That's really the target borrower. And I don't want to say it's a Band-Aid loan because we never like to project and make any promises we can't keep, but typically these loans are held for maybe 6 to 12 months. And after the borrower strategizes with their accountant and does some strategic tax planning, then in the future they can get into a more traditional loan product with a lower interest rate. So ask any one of our team members. We're all here for you to give you more information on our new Flex suite of products, the non-QM products that we just rolled out in the last couple of weeks. So with that, thank you everyone for being on today's call. We really appreciate your attendance. Again, if you have any questions, feel free to reach out to anybody. But for now, have a great day and good rest of the week. Take care, guys.